to our talk of the tape, the fate of the rally with stocks once again reaching new highs this week. So can the momentum continue? Let's ask Tom Lee. He's Fundstrat's managing partner and head of research, and as you see, he joins me now. Tom, it's good to see you. Welcome back.
Good to see you, Scott.
That was the news of the day this morning. We're buyers of stocks on Friday, but even stronger if the jobs report is soft. The implication being you're buying no matter what. So it wasn't soft, it was hotter than expected, but nonetheless, why did you come into today thinking you were buying stocks regardless?
Well, there's a couple reasons, Scott. The first is that I think markets are much more focused on inflation reports and CPIs next week and the June FOMC meeting on Wednesday. And the second, which of course we think is going to just show a continued improvement in inflation, but the second is that stocks really historically have done well in the week following the release of the employment report, rising roughly 70% of the time, and it implies roughly 70 to 80 points in the S&P. Of course, it would be better if it was a soft jobs report, and it wasn't.
Well, it's funny you say that. It would be better if it was a soft jobs report, because I think the market spent a good amount of today deciding, what it was. Was it good news is good news is bad news? I mean, if the market doesn't necessarily need rate cuts, why is a softer report better? Why can't we just be happy with good news? Labor market's strong, economy's hanging in, don't need rate cuts, and still may get them later this year.
I generally agree with you, Scott, but as you know, there's a faction of both market participants and FOMC that view some of this data as too hot for them to be comfortable with, and I think the more positive data points you get, the more you might actually start to see markets price in a hike. And so I think you're right. There is a Goldilocks window, but it's safer to say bad news is good news because those actually clearly take away inflationary pressures.
I'm wondering if you think in any way that, thinking that June is going to be the point of the year in which we start to get this money off the sidelines and into the market, and how Goldman Sachs framed it the other day, talking about a, quote, wall of money coming in, but not really until July, that you could have some selling between now and then, but that the beginning of the third quarter and thus the second half of the year is the area to really plan for a wall of money coming into this market and then pushing stocks that next leg higher.
Scott, that dynamic is certainly at play for a couple reasons. One, April was a down month, and I think a lot of institutional investors actually sat out May thinking April was the start of a bigger correction, so June is when money starts coming back in. But I think more importantly, since the end of 2022, I think a lot of institutions and a lot of high net worth individuals sort of sat out this market saying, hey, I'm happy earning 5%. By the middle of this year, if the S&P is up 15%, on top of missing 30% last year, I think a lot of folks are going to say, listen, I can't just sit on cash and earn 5% anymore when I'm missing out potentially on a 25% year for the S&P.
Tom, what'd you make of the fact a couple times this week we had rates go down and stocks go down? Not exactly the dynamic that many had been expecting, right? Because that's not the way that stocks and rates have been reacting, right? They've been pretty well correlated. Rates down, stocks up. Well, there were a couple of occasions this week where that didn't work. Why?
It's kind of hard to tell, especially day to day, but if I had to guess, we don't want to be in a situation where the economy is slowing so much that we've actually hit stall speed, so rates would go down. That type of economic dynamic would scare stocks. So it's almost like bad news is too much bad news. In fact, maybe that's why today's jobs report kind of fits right in the middle, because it's actually good enough to tell us the economy is still strong, as you said, but it's not enough to actually add to inflationary pressures.
Tom, what if this market is just screaming out it's NVIDIA's world and we're just living in it, right? I mean, NVIDIA's up, markets are good. NVIDIA's not doing much, S&P can't do that much, NASDAQ's negative today. It's a one stock story.
NVIDIA is really a generational story for now, because how many $3 trillion companies actually have doubled, so clearly NVIDIA is important, but it's important because it's really one of the most important ways to get exposure to AI. And I think the AI story is, early innings, as many people talk about. It's transformational in terms of productivity, and there's a lot of use cases developing. So as much as it might feel like a one stock market, as you know, there's a lot of stocks up more than 20% year to date, and I actually think breadth is likely to increase. So for investors, there's a lot of opportunities in the second half.
Yeah, I mean, that's the one question, whether, this broadening rally that we had enjoyed has suddenly become too narrow once again, and it's all focused on the mega caps. Whether if it's not Nvidia today, it's Apple on the run. You're still comfortable suggesting that people buy those stocks even at these levels?
Yes, because these companies aren't at valuations that are really what we call demanding. I mean, the cost of debt for Mag 7 or the FANGs is lower than many governments. They're still growing earnings at 20% and top line 10%. I don't see why investors shouldn't be paying much higher multiples for these stocks. And now when we look at the rest of the S&P, you're paying a median PE of around 16 times with yields falling. So I think the whole market actually has multiple expansion potential.
The other point you make today is that you want to stick with what's working. And that obviously plays off the Nvidia story. But also you suggest financials and industrials are a place to be. Now, they may have been working, but I'm not necessarily sure over the last month they've given a lot of enthusiasm to investors that they're going to continue to work. Why do you think they will?
Well, both stocks are responsive to a healthier economic outlook. So you're right. I think in the past month they've done poorly, and I think part of it is because there has been some doubt about sort of the robustness of this expansion in labor markets. But the PMIs look like they're turning. New orders could be bottoming. Historically, that's very good for industrials. And the case for financials really depends on the Fed maintaining a dovish bias, which is what we expect. And I think that's going to come out in next week's meeting, and that's a tailwind for financials.
All right, I want you to stick with me because I'm going to come back.